Good morning and welcome to the Monday Morning Market Wrap. I'm Greg McKenna. It's Monday the 19th of October 2015. Markets had a good night on Friday night with stocks in the US and Europe all in the green. That's nice for a change, but it's really more historical than usual on this Monday because it's Chinese GDP day. At 1 o'clock today we get the release of Chinese GDP and the market range is anywhere between 6.4% and 6.9%. The average is 6.8, so it's obviously there's a skew higher. And that's really important because obviously the Fed back in September said that conditions abroad were one of the reasons why they decided not to hike. And so this Chinese data comes at a time when markets are trying to figure out just where things are, just where is China, just where is emerging markets, just where is the Fed in terms of its thinking. So we'll know later on today. It's a massive number, but it's not just the only number that we get out today. What we also get out is urban investment, retail sales. Retail sales, 10.8% growth rate year on year is what's expected. Urban investment, the same, and then industrial production. Now, GDP data, lots of people think it's kind of a fudge. So how that prints is important, obviously. A low number, and you'll see markets just go into a complete funk. A high number though, and you might see a little bit of weight lifted off the Aussie, and you might see the stocks, rally a little bit. It'll depend on which way we go. Over the weekend, both the President and the Premier of China were talking, and the Premier's comments that maintaining growth of around 7% isn't easy certainly suggests, at least anecdotally, and one anecdote's not evidence, let alone a couple, but at least anecdotally that potentially this could be a slightly weaker than expected number. Certainly that's the case if you have a look at Westpac's chart that they put in their weekly this week. So you can see here, this is China business conditions. So the trend has been weaker for some time. Now, of course, that makes sense. The Chinese economy is growing still at a really good clip, but it's growing at a slower clip than what people had thought in the past. So on that basis, it's probably worth having a look at a piece I wrote at Business Insider yesterday, which was the HSBC chart of the week. And what that is it's showing both the importance, I should say, of Chinese growth on both a PPP basis and a US dollar basis, plus also emerging Asia. So 17 plus 16 is 33%, a third of global growth in PPP terms, and you've got 25% in US dollar terms. More importantly, however, as you can see in this chart, right, all of the growth is either coming from the US or China and Asia. Everything else is really detracting from growth at the moment. Now, that really puts into stark light exactly why things are looking, why there's so much focus, I should say, on China and that. So let me just quote what HSBC said. If the East were to skid off the rails, it's everyone's problem. Next, with Asia growing below trend, it's hard to see global inflation picking up. Remember what I always say about inflation? Inflation is a result of aggregate demand. So it's hard for it to pick up meaningfully. That means monetary policy across the world should remain fairly accommodative, supportive of stocks, apparently. This in turn is good news for the East. While it now generates a lion's share of world growth, its financial conditions are still powerfully influenced by central banks and capital markets in the West. So what does that mean? That means that what happens today in China and with Chinese growth is going to be vitally important for the outlook for markets. So with the ASX 200 up at the top of its range, 22-point rally on the December SPY 200 futures last night, with the S&P up at 2033, and most people I think thought 2050 might be the top of the range. You can see that this data couldn't come at a more. It's got the ability to either completely derail the rally or give it that turbocharge that earnings seasons lacked. Last week, the Dow was up 0.9%. Not a terrible week. It was its third week in a row that it's rallied. So not a terrible week, but not the best week ever. Turning now to foreign exchange. And the Aussie dollar's been under a little bit of pressure. You can see here that it has broken the recent uptrend line. That's where it is this morning, around 72.58, 72.63 on Reuters at the moment. And so this is the uptrend line that we've seen from back at the second test of the 69. I think it was 34 was the low. Now it's normal for it to head back towards my fast moving average, as you saw here with this down day. We got just above it. We found this trend line goes back for years and years and years, and so it's due to come down into this 72 flat, 72.20 kind of region. We'll see. But realistically, it all depends on what happens at 1 o'clock today with the release of the Chinese data. My levels that I'm watching is at 72 figure 20 level, 72, 77.85 region topside, and then 73, 30, 25.40 are the levels to watch. The level of that actual trend line is in that 72.70 region. So keep an eye on that. We'll see how it goes. Elsewhere, a few things worth noting. What we've seen over the last few days in terms of trade has been that people are starting to expect that the RBA will cut rates. Now, I'm still not sold on this. I think this is a horrible game of game theory from the majors. The majors know that the smaller banks are squeezed. So if a major hikes and the RBA cuts, the major wins in two ways. The major bank wins because it increases its margin, and in Westpac's case, all other things equal, it's going to get an extra $600 million of income from its mortgage loan book. Mutual banks, the rump that make up the rest of the industry, are going to struggle to increase their rates. A, because it's not their style. B, because they can't argue the increase in capital costs. They just carry more capital. And so what that means is if the RBA cuts, you get a compression in margin for the mutuals at a time when the majors have expanded. What does that do? That means the status quo remains. That means mutuals aren't competitive. That means the majors retain their preeminent position. I think the Westpac move's a really cynical one. I think they've thought long and hard what they're doing. So I'm not convinced the RBA is going to take the bait and just cut. Certainly not in November. I think they'd be mad to. We're seeing business conditions picking up, business confidence picking up. And I know that some advocates say that now's the time for a 25-point cut. And we know that the banks would pass that on in an instant to business owners. But it's not certain they'd pass it on to mortgage holders. And so we've got this game being played. So I'm not convinced that the RBA is going to cut, but we'll wait and see. Obviously, for the Canadian dollar, today's election, tonight our time, is going to be really important, and we'll keep an eye on that. Otherwise, currency markets didn't do too much. Commodity markets were fairly quiet. We had a better performance in crude. Crude's up back up at 47.26. So it's looking okay. Gold is back towards a couple of moving averages and struggling a little bit. Elsewise, Goldman Sachs. I thought Goldman Sachs had moved their expectation of the Fed 2016, but as I highlighted in my 20 seconds piece from at Business Insider this morning, it seems that goldies are still in December. Jan Hatzius, I should say, who's the chief economist for goldies in New York, has said that they still think the Fed's going to hike. The key thing he does say, though, is that it's data dependent. It always is. We know that. But he thinks that they want to. Interestingly, though, expectations are only 30% that the Fed's going to hike. So if the Fed doesn't want to blow markets up, it needs to massage those expectations higher. So it's going to be really important to watch Fed speakers over the next sort of month. Also the data, obviously, but we get a couple of Fed speakers. That's going to be really important. How the data prints, what the Fed says. Because if the Fed hikes with 30% probability, stocks and everything else is going to get smoked, because that'll scare the heck out of people. So keep an eye on that one and how that unfolds. So that's pretty much it, I think. Data from China today is the big one. There's nothing out in Australia. Only the NAHB index, that's the home builders index in the US tonight. There's a great preview of Chinese GDP that David Scutt has written on Business Insider. It no doubt it's going to be on the front page. Have a look at that. One thing I also picked up and put in my 20 seconds piece was Wolf Richter from Wolf Street highlighted that Moody's has jumped on the bandwagon calling for a US recession, which I found really interesting. They're talking about junk bond rated, so non-investment grade rated companies not being able to access cash in the globe at the moment, and only one issue in the US over the past 3 weeks. That's really important. If companies can't access cash, they can't invest. So you could get it looks like you might be getting a credit crunch in that higher yield non-investment grade companies, which, let's face it, that's where most of the economy sits. You know, BBB plus is still a bloody good rating by global standards, and a lot of companies can't get that. So that's the market that they sit in. We might call it junk, but realistically, that's just real world companies who don't have who are doing good things and don't have the structure that a GE or somebody else has. So anyway, that's it from me. It's Monday morning. It's 9/12, the 19th of October. Have a great day. 1 o'clock. Watch the Chinese data. We'll be covering it live at Business Insider. I'll be tweeting about it. It's going to be massive, and so watch your levels. But it's not a turkey shoot. It's the opposite to that. This could print anywhere today. A good print would be 6.8. Not bad enough to knock expectations about the real path of growth. Enough to make people skeptical again, but hey, that's another story. The comments by Lee and Z over the weekend suggest more stimulus is coming, so I'd expect that. Anyway, have a great day. You can catch me on Twitter at Gregory McKenna. You can catch me at Business Insider, of course, or at my own website, gregmckenna.com.au. Have a great day. Bye for now.